Hello Freedom Builders and welcome back to the channel. Today we're going to talk about something called the Fear and Greed Index. And the reason for that is that right now, and we are talking the end of February 2020, it seems like we're going to have some sort of drop in the stock market. Nobody knows how big it'll be, but I thought that would be a good time to make a little video about this Fear and Greed Index. I have written here, let's be like Warren Buffett. Buffett is famous for saying, as it says here, be fearful when others are greedy and greedy only when others are fearful. Meaning that when the market drops and everybody is running and screaming, that's when you should consider buying. And of course, when everybody runs into the market and want a piece of the cake, that's where you should consider selling some of your stocks. But that is way easier said than done, because how on earth are we going to do that? Well, luckily for us, there is a little tool called the Fear and Greed Index. It's a free tool and it is on CNN Business. I'll put a link to it below. That tells us a bit about how the market is actually, in what state the market is in. You can see here that it is going from extreme fear to extreme greed. And of course, when we are down here at extreme fear, that is when most investors are running out and dumping all the stocks, and all the clever money, they are picking stocks up. On the other hand, here at extreme greed, that is where we are all buying. We are all buying stocks that are not making money, but we are just buying it because they're going up. And that is where the clever money are selling us their money because they can see they are overpriced. So let's just have a look at how this Fear and Greed Index is. You can see here, by the way, that a year ago we were at 68. A month ago we were at 74, which is up in the greedy section. Then we dropped down to 55, 49 just last week, and now we are at 44. And that one is changing all the time. But let's see how it is calculated, because there are 7 different indicators that is put into this Fear and Greed Index. The first of them is called market momentum, and this is actually quite basic. Here they are taking the S&P 500 and they are putting a 125-day moving average on it. You can see it here. And the farther away we are from above the 125-day moving average, the more greedy the market is. So right now it says that the S&P 500 is around 7% above the average. This is further above the average and has been typical during the last 2 years. All right, so we can see here that this indicates greed. But I can tell you one thing, and that is when the market opens today, this one will drop. Right now it seems like the S&P 500 can easily take that 2, 3, maybe more percentage downwards, so that will bring us closer to this and closer to neutral or fear. But right now we are at greed. Then we have the stock price strength, and here they're taking the number of stocks that are hitting their 52 weeks high, meaning the 1 year high in price, and they are comparing it to the number of stocks that are hitting their 52 weeks low. So in a bull market, when everybody are greedy, there will be a lot more stocks hitting their 52 weeks high, because we are pushing the stock prices up and up and up, and not many stocks will hit the 52 weeks low. So we can see here that the number of stocks hitting 52 weeks high exceeds the number of hitting lows and is at the upper end of its range. So we are still in greed here, but you can see that has been dropping. And again, believe me, when the market opens today, this one will drop as well. The third one is junk bond demand. And not many people are looking at this, but I think it is a very good indicator to have here in the Fear and Greed Index. Because what we can see here is that, first of all, the concept of junk bonds means low quality bonds. It is risky bonds where you are less likely to get your money back than if you're buying the more safer investment grade bonds. And what we can see here is that when normal bonds, when government bonds and so on are going towards zero in interest, then there is a higher and higher demand for junk bonds, corporate bonds like this is. And here we can see that people are accepting only a 1.77% additional yield over the safer bonds, even though they're taking on a lot more risk. And in times of a lot of greed and a lot of the people are feeling like the future will be stable and solid, well, then people are saying to themselves, why not take the junk bonds, even though it is on paper lower quality and with higher risk. Everything is going fine right now, and I can just take on this extra risk and take the extra premium. So what we can see when people are fearful is that they are demanding a higher premium to take this extra risk. And when people are forgetting that there can be any risk in the market, we can see that this junk bond yield is dropping. So they are only taking about 1.8% extra yield to take a lot of risk. And that also tells us a lot about greed. And believe me, that one will go up as well in a short while if the market drops just a tiny bit. Then we have something that it says market volatility, and that is something called the VIX Index, and many of you might have heard it called the fear index. It is not really a fear index, but it is a measurement of how much volatility the market expects over the next month. And you can see it's called the CBOE Volatility Index, or the VIX. It is at around 7. And that is 21% above its 50-day moving average. What this is that to those of you that are not too much into options and option pricing, I can see in a lot of Facebook groups that people love the options, and I can also hear that not many have any clue as to how they are priced. And it is quite a complex formula called the Black-Scholes formula. But one of the main moving parts in there is something called implied volatility. And that one determines how many swings people expect in price, how much volatility they expect over the next month. And when this one goes up, it means that the option prices are often, at least the put prices, are often going up because people are buying more insurance because they are expecting more volatility. That means that the option sellers can earn more money, but they're also taking a larger risk. The implied volatility part of option pricing is actually something that is completely forgotten by most option traders, and that is why when we all of a sudden see some volatility comes in, we can see option investors and traders really get hit because they don't know how they're priced. But what we can see here in the VIX index is that when it goes up, it is because people, the investors, the professional part of the investment community, they expect some higher volatility in the market, and that one will definitely be going up these days, no doubt about that. But right now we are at fear, and I expect that we could quite quickly come into extreme fear on this one. Many people, and easily seen in the media, they're using this VIX index as the main, as I said in the about it, it's called the fear index, and it is a bit of a clickbaity title, but it is an important factor to look at. And right now we can see that expected volatility is going up. And as I remember saying before in videos, there's this old investor saying going like the bull market takes the stairs and the bear market jumps out the window. And that means that the bear markets are always moving faster. They are not just tiptoeing down slightly a bit every day. When the stock market drops, it drops quickly. And that is pretty much what is shown here in the VIX index, that people are not expecting high volatility in a bull market, because everything just goes up slightly a bit every day. But all of a sudden, when we see a bear market, or at least some sort of correction, we see the volatility is spiking heavily. So the VIX index is an important factor to look at. Then we have something called the McClellan Volume Summation Index. And I know it sounds a bit weird, but what it actually does is, and it is a very good market breadth indicator, what it does is it shows us, compares the stocks that are increasing in price with the stocks that are declining in price, and then they're looking at the volume there to see if there's more volume on the falling stocks than on the rising stocks. And right now we can see that during the last month, approximately 1.26% more of each day's volume has traded in declining issues than in advancing issues. So that shows us that there are more volume on the stocks that are dropping than on the stocks that are rising, just on average over the entire market. That shows a level of fear that we should be aware of. Then we have the put and call option ratio. And again, if you're not too much into options, it can be a bit difficult to explain quickly. But basically, a put option is an insurance. So if I have this stock at 100 and I buy a put option with a strike price at 90, 3 months out in time, it means that the next 90 days, in the next 3 months, I can sell my stock at $90, no matter how much it drops. If it drops to 0, I'm still guaranteed that I'll get $90 for my stock. So it is an insurance, instrument that many professional stock traders use. If they don't want to sell the stock, then they can guard themselves a bit off here. And what we see here is that when the amount of put options is going up, when this put call ratio is going up, then we can see that people are actually buying more puts compared to how many calls they're buying. Because a call option is the opposite, that makes sure that you can buy a stock at a certain price into the future. So that is when you expect the market or the stock to go up. So when we have more put options than call options, means that people are more fearful. And here we are at extreme fear. The last one is safe haven demand. And that is the demand for bonds, basically. It says here, bonds have outperformed stocks by around 1.6%. Percentage points during the last 20 days. That means that people are actually accepting the very, very low interest in bonds over some a bit more risky percentages from the stock market. So we can actually see that there has been a movement from the stocks into the bonds over the last 20 days, and that is at a level where we can see extreme fear. So the overall market has basically been moving slowly towards the fear scenario. And that is what is shown here altogether, that we have now moved into the fear area, and that can easily drop. I suspect this, when I put this video out later today, I could easily see this dropping to 30 or 25. What we should be aware of is that if it goes down here, and I have seen many times this one hitting 3 or 5, a few times a 0, but when we are down here at extreme fear, that is where, at least in theory, that many of the large players in the market start to look for opportunities to buy. And they know that when the place they make their money is by buying and selling stocks to us, the dumb money. And as I said in the other video the other day, it is not because you are dumb or I am dumb, but we are the least informed investors. We are the ones that get the information as a last piece of the chain. So that's why we are called the dumb money. And the large players in the market, when we are down here at extreme fear, they know that we are just selling and selling and selling. Even high value stocks that can almost only go up over time, we are selling them because we are afraid, and these large players, they are buying them up. On the other hand, here at the extreme greed, that is where people are pouring into, and I know I will get some hate for this, but the Virgin Galactic, the Tesla stock, and that can be fine stocks, and there can be some great day trading profits made there. But the movement of money into these sort of stocks that are not really making money, but are extremely highly priced, shows that we have been in an extreme greed area for quite a long time. If we go down here at the bottom, we can see that this is the graph of the fear and greed over time. And you can see, if you remember the beginning of 2018, you saw it had been an extreme greed level and had been dropping here, and we saw some drops in the market. 2018 was a very tough year to make money. The overall market dropped, and it spent a lot of the time down here in the greed area, and actually also in the extreme greed, but it stayed there for a while, and it was a tough year to make money in 2018. Then we saw 2019, that was last year, and many people were surprised that the market actually started spiking up. But we could see it here in the beginning of the year that we got into a slight greed area, but we never got into the extreme greed. So actually for the first 2-3 months of the year, we saw that the market was going nicely up. Then we saw some choppy market over the summer, and that was hard for a lot of investors. But then we saw from October on, we went into greed area again, and we have actually been up at 100 here not long ago. That one we have dropped from that, and right now we are moving into the fear territory. And if we are staying down here between 20 and 50 for a while, that could mean that the stock market would chug a bit down in the coming months. If it drops way down to 0 or 5 or something like that, that would indicate that we would see some sort of bounce pretty quickly. But then again, let me just draw it with some arrows here. If it drops quickly, as we saw down here, if you remember the Q4 in 2018, then it did bounce. But these movements here, if you're looking at a price chart over the Dow Jones or the S&P 500, you can see that we dropped, moved a bit up, dropped, moved a bit up, dropped, and that is what this scenario here is showing us. So right now we are in a scenario where we are just tipping down into the fear area. And at the price level we are in at the market right now, that could mean some heavy drops. And when I say heavy drops, I mean somewhere between 10 to 20%. I'm not talking recession here, even though there are a lot of numbers that concerns me a bit. There's a coronavirus, there are some PMI numbers and so on. But this is only measuring what is the psychology in the market right now. Are we pouring into the market? Are we pouring out of the market? And right now it seems like some instability has been growing in the market, and right now people are getting somewhat more fearful. So I recommend that once in a while, maybe once per week or once every second week, you just drop by this CNN business site. As I said, I'll link to it below, and just see where is the market. If you have some stocks that you are considering selling, and you can see that we are up around extreme greed, well, then might be the right time to sell. If you're considering to sell some stocks, but you can see that we're almost here at extreme fear, then you might want to hold on to them, because there might be a correction where you can sell them a bit more expensive. All right, I hope this makes sense. I use this, I look at it at least a couple of times per week, just to get some sort of psychological assessment of the market, to see if I should be fearful or I should be greedy. And as I said, the good thing here, when we are in the middle part, you should basically follow the market. From 50 and up to around 70, the market is in a good way greedy, so they're buying up stocks, so you should just follow the market. The same way, when we are from 50 and down to 20, 30 something here, you might consider selling something, or at least following the market if you're a bit shorter term trader, because that is where we have this kind of stable downturn in the market. And then we have the extreme fear, the extreme greed. That is where you should consider doing the opposite of the market. I hope that makes sense. If you have any questions for it, just drop me a question below in the comments. If you haven't done already, remember to subscribe to the channel, hit the like button down there and the bell notification, so we can help the YouTube algorithm knowing that you want to see more of this stuff. That's all for now. I'll talk to you soon. Take care of your money out there, and bye for now.